All right, folks, welcome back. It's time for your Sunday Money. This week, a viewer asked, what is the cost basis of an investment, and do I need to keep this information for both taxable and tax-deferred accounts? Well, fortunately, I don't have to answer that. We've got our money man, Paul Fain, here to talk all about it. He's the president of Asset Planning Corporation. Paul, thank you for being here today. Let's talk about this viewer question, because a couple of good questions here.
Yeah, it's got some nice layers of the onion we can peel back, Sean. So basically, what is your cost basis, or also, AKA also known as tax basis, is your total contribution, your total investment into an asset. So it could be a stock, a bond, a mutual fund. It could be a real estate property. So say you initially invest $5,000 in the XYZ fund, that becomes your initial cost basis or tax basis.
Interesting stuff. Okay. So what about the factors maybe that increase or decrease that cost basis?
So we might make additional investments. That adjusts our cost basis. We may make periodic sales. That could adjust our cost basis. With things like investment accounts like mutual funds, many people reinvest their interest in dividends. You pay tax on that as you go in a after-tax brokerage account, so that's adjusting your cost basis. With improved properties like real estate, rental house, home, you may re-roof, you may add a new heating and air unit. Those are also additions to your cost basis.
That makes sense. Interesting. Okay, so what about this? Why is this information, I guess, important to track? I mean, you want to keep track of it, probably with anything else. But
well, and that raises a good point, Sean. Do track your cost basis.
Definitely.
Keep up with your records. With many investment accounts, the brokerage firm, bank, et cetera, will keep up with in a column, your cost basis. If not, you need to be keeping up with some important records. But the most important moment is when you actually sell something. You've got to have this information to determine whether or not you have a tax liability. So if you made money, you've got a capital gain. If you lost money, you have a capital loss, which could possibly offset some other income. So in our example, you invest $5,000 in the XYZ Mutual Fund. You later sell it for $7,500. You've got a $2,500 capital gain.
Interesting stuff. All right. Well, let's talk about the fast market fact here that we've got coming up here. I'm sorry. Let's talk about, do we need to track the cost basis in a tax-deferred retirement account? What about 401k?
That is a great question from our viewer in the email that I received. So with contributions to, say, a traditional IRA or 401k, you're not taxed. They're tax deductible. So you're only taxed when you take money out on 100% of what you withdraw, what you put in, what it's grown to, and it's taxed as ordinary income tax rates. However, if you make a non-deductible IRA contribution, in other words, you've already been taxed on what you put in, you need to keep up with your cost basis in that non-deductible IRA. And we'll briefly mention, if you work for a company where you can buy company stock in your 401k, there are some special rules to take that money out of the 401k, just that money associated with your company stock, and pay tax on that and preserve the gains for later taxation. So you'd need to keep up with your cost basis in that incident as well.
Okay, cost basis, good to know, Paul. Awesome. So how about that fast market fact? Now we can get to it. So Paul, what do you got for us today?
Well, I think while we're on the topic of capital gains, let's talk about the tax rates. So what are the long-term capital gains tax rates, Sean? That means you've held that investment or property for at least 12 months. And we have an example, say, of a joint married income filer. You can see that the tax rates go from 0 to 15 to 20% depending upon your adjusted gross income. So for example, if your adjusted gross income is under $78,000, you owe no capital gains when you sell an appreciated property. However, above that, again, you could be paying it 15 or 20%. In a higher income household, a joint filer over $250,000, then you might even have a surtax of an extra 3.8%. But still, could be lower than your ordinary income tax rates.
Absolutely. Well, Paul, good stuff as always, for sure. If you have a question for our money man, Paul Fain, just email him. It's paul@assetplanningcorp.com.